Andrew, as co-lead portfolio manager of the international strategy, how do you think about the effects of property deleveraging and slowing economic growth on the prospects of the companies held in your portfolio?
There's a couple of levels to answer how China's economy is affecting our investments. Big picture, keep in mind that while we own about 8% of our portfolio in Chinese companies, a couple of those get around half of their sales from outside China. So to some extent, those aren't fully exposed to China's economy. And at the same time, we have companies that aren't Chinese that also have significant exposure to Chinese sales. So for example, auto parts companies might be getting 35–40% of their sales in China. Luxury goods companies typically are earning about a third of their sales in China. And I think so far those are holding up, but we'll see. Cosmetics companies, we have a couple in the international portfolio, and their sales continue to grow in China, but are feeling some pressure. So in aggregate, our entire portfolio, we calculate, derives about 17 or 18% of aggregate sales within China, which is including both Chinese and non-Chinese companies. Included in our non-Chinese holdings are mining companies, so Rio Tinto and BHP. Both generate more than 50% of sales, which is coming primarily from iron ore sales to China. And the interesting thing is, even with the construction slowdown in residential property in China, overall construction isn't really down in China so much. And steel production in China year to date through July is actually up a couple of percent. And so iron ore prices remain fairly high, over $100 a ton, which is above average looking back at the last 15 years or so. So it's not that China's economy is creating collapsing sales or earnings for the companies that we're watching. And so that's an important signal beyond the economic data, is that a lot of companies are still seeing robust demand coming from China. Some specific Chinese companies where we can see what's been going on in the first half of the year. Ping An Insurance, for example, has seen its life insurance premium sales rising 8% in the first half of the year. So that's a pretty normal number, actually improved from some prior years where you had COVID shutdowns. Haier Smart Home, which is a manufacturer of white goods, both in China and exporting from China, and manufacturing outside of China as well, not just exporting. They saw pretty strong growth from Chinese white goods sales in the first half of the year, where export markets, I think, were actually weaker for them. Non-Chinese was weaker from them in the first half versus Chinese white goods sales. So there's still demand. It's not a crashing demand at the household level. At the heavier industrial side of the economy, maybe things are more stressed out. I think natural gas sales going to the real estate sector was down double digits, but in other areas, there's still areas of strength. I think Lee can talk about some of our faster growing companies where we have several companies that are generating greater than 20% sales growth and higher profit growth.
The reality is that China is a big place, and it's big enough for different things to be happening to different industries and different companies than the overall economy, which has clearly been seeing a a slowdown in growth. Real estate has consistently been overinvested in over the last decade at the least. And that transition from building stuff at maybe declining marginal rates of productivity and towards making stuff, especially higher value add, globally competitive things, that's been happening for some time. I think a lot of companies have actually been growing at well in excess of 20%, even while overall economic growth has been slowing. And many of those are in several globally competitive sectors, including the automotive sector, in particular electric vehicles and batteries and other components, as well as solar and consumer electronics. And even as the real estate sector in China continues to be quite weak, quite a few other parts of the economy have actually been doing fairly well. For example, when Japan was doing not so well as an economy, there were still a number of companies that were able to do fairly well. Of course, I think policymakers in China are trying their best to avoid a Japanese scenario at the moment. But I think it's the same context. Different industries and companies can have fairly different outcomes than the overall environment.